Hey, good morning, options traders, and welcome back, everyone. I've got a really good question for the group. Came to me in the form of an email from one of the traders in our group, and he asked, what's the difference between doing a covered call versus selling straddles against your stock? He said, it seems like there should be an added risk, but I'm not seeing it on my risk graph. Well, it's a good question, and so here's the problem. If you buy 100 shares of stock and sell a call against it, this is your risk graph. And if you buy 100 shares of stock and sell a straddle against it, this is also your risk graph. At least apparently so. So what's going on here? Does it make sense to sell the straddle and get more money and therefore increase the benefits of the covered call? Well, it's a really good question, and so let's take a closer look at the covered call and what's really going on with this question. So first, the covered call, the basics. Remember, you're going to buy 100 shares and sell, let's say, maybe the $100 call. It's just going to be some type of a strike, but it's always in a 1-to-1 ratio, meaning that if you buy 200 shares, you could sell 2 calls. But the main goal of the covered call is always downside protection. Sometimes you'll hear traders that confuse this concept and they say the reason for selling the call is for income generation. And while that's one way of looking at it, it's not really the proper way to see it. Why? Because when you sell that call, you're really selling off potential future capital gains in the stock. Well, that's not really generating income, it's just selling off some of your potential revenues. So the main reason for doing the covered call is to increase this downside. So how can traders increase this downside protection with a covered call? Well, very easy. You can always increase it by selling lower strikes. If you were going to sell the 100 call, you could sell the 95 or sell the 90. And as you lower those call strikes, you're going to increase that downside protection. But it comes at a cost. As you increase that premium, you are going to decrease your profits. So for instance, let's say that you buy shares of stock and sell the 105 call. You're going to get a bend at your strike. That's always true for your profit and loss diagrams. But let's say that you sell a lower strike, maybe the 100 call. You're going to shift from the red to the blue. So do you see how I've increased the downside hedge, but it comes at a cost in the form of lower profits? That will always be true for the covered call. What would happen if you sell the 95 strike, an even lower one? Same idea. You're going to shift that downside hedge even lower. That's a benefit, but it comes at a trade-off that you must accept lower profits. So do you see what's happening? By selling lower and lower strikes, you're increasing the hedge, which is ideal, but you're also reducing the profits. So if you sell this 95 call, you've got this little sliver of profit here, but if you sell the 105, you've got the premium from the call plus the capital gains. It's a trade-off. And so this is really what led to this person's question. He said, I get exactly the same graph if I sell a straddle, but yet I'm getting twice as much money. I'm increasing the downside hedge, but I'm not really accepting any more risk. Well, the answer is that you are, in fact, adding to your risk. Yes, you're getting more money, but you're also increasing the downside risk. But again, how is that possible if you're getting the same shaped graph? Well, let's first take a look at the short straddle. That's a strategy where you may sell the May 100 call and then maybe sell the May 100 put. It's a call and a put, same strike, same expiration. And that strategy by itself is going to look like this. You will have unlimited risk to the downside and unlimited risk to the upside. So again, this is why the trader was saying, if I've got unlimited risk with my stock and then I'm adding to it with this put, why am I not seeing it on my graph? So that's what led to his question, what happens if you sell a straddle against your shares? Well, let's try it. Let's say that you buy 100 shares of stock trading for 100, and maybe instead of selling the $100 call for 4, you double up on it. You sell the $100 straddle for 8. See, this was his whole point. I'm getting more money, but if I put this in my broker's platform, I get exactly the same risk graph. So why wouldn't I do it? Well, here's the answer. It's really an optical illusion. And this is why it's so important to understand your strategies, your deltas, profit and loss diagrams, all of the things that I teach in the classes. But what's happening here is that your broker's platforms have two different ways of presenting a profit and loss diagram. For instance, let's say that you did this same strategy right here twice. Well, you're going to get exactly the same risk graph. What's your broker going to do? Your broker is going to change, just on your platform, this maximum gain from 8 to 16. And it's going to change this maximum loss at around minus 30 to minus 60. If you put the strategy on 3 times, the picture never changes. But now this is going to show 24, it's going to show 3 times 8, and it's going to show down here of about minus 90, 3 times minus 30. And so that's why it appears that your risk graph isn't changing. It's because the broker is keeping the risk graph the same, but just changing the numbers. So the easiest way to see this in your broker's platform is to overlay both strategies on the same graph. So let's try it. Again, what we're looking at here in red is buying 100 shares and selling the 100 straddle. But what if we overlaid buying 100 shares and selling the 100 call? Now we're going to get this. Now we can see that there's a clear difference. Yes, by selling the straddle, you will in fact get more money. That's the part that he was feeling intuitively. I'm receiving more money. But what he wasn't seeing on the graph is that he was increasing the size of the deltas to the downside. And that's because on the blue line, if you just buy 100 shares of stock and sell a call, you've got 100 deltas down here. But if you buy the shares of stock and sell the straddle, not only are you long those shares of stock, but you're also short the put. And that also adds deltas to your position. So in the red graph, you're actually long 200 deltas. So yes, by selling straddles, it will appear to keep your profit and loss diagram exactly the same as it is for a covered call. But the difference is, mathematically, you're really buying 200 shares and selling 2 calls. Now again, I know that can sound confusing for people, but this is why people miss opportunities and they also step into traps. Very easy to do unless you understand exactly what it is you're looking at. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.